happy to welcome you all to the webinar presentation of the Health Wealth Capital in conjunction with AJ Peak. I'm going to go through the first few slides here myself, and then I'll introduce AJ and he'll take it from here. So we have some disclaimers here. I'm not going to read all of them, but in the recording, feel free to pause on the screen and take a look. It's pretty standard. I think all of you guys on the webinar at least know me pretty well, but my name is Daniel Shin. I'm a board certified urologic surgeon, investor, and I founded Cereus Real Estate to bring wealth growth and cash flow to high income professionals to allow you to take control of your personal and professional lives. So what I'm going to do here over the next few slides is just do a really quick bird's eye view of a few pertinent points. Obviously, AJ in just a few minutes is going to really get into the details. But basically, what this is it's giving us access to institutional grade medical real estate investment. And, at a high level, there are a lot of great things about diversification, even within the field of, real estate. So, especially over the last year, one of the focuses that I've been embarking on is to offer a diversity of investment types, not only multifamily. So this is one of those, it's going to offer us the ability to diversify while also offering very, significant projected returns. So AJ is going to talk about the specific qualities of the deal that are really interesting, such as the triple net leases inherent in the real estate fund, the deal duration of probably 3 to 5 years, and some pretty great baseline returns, projected returns, with potential for a significant upside. So, for example, projected 7 to 8% cash on cash return, 16 to 20% internal rate of returns, which equates to about a 20 to 30% annual rate of return. Minimum investment into this deal is $50,000, and it is for accredited investors only. So this is sort of restating some of the base case economics. Inherent in the deal is something called a waterfall. And what that basically means for our investors is that the better the deal does, the better it becomes slightly more favorable to our sponsors. And some people are turned off by our waterfall. I love waterfalls because I think it incentivizes the sponsors to do an incredible job. And if the waterfall is triggered, it just means that we're all doing really well on the investment. So you can see those numbers here. Once cash flow starts, it's going to be paid on a monthly basis. And there are depreciation opportunities inherent into the deal. These are the returns specific to Cereus Real Estate investors, which, as you can see here, are a little bit more favorable in terms of the waterfall and splits, the preferred return. And you can see here that there are kind of two scenarios. AJ is going to discuss how there's a base case scenario, and there's also upside scenario. And I think that's probably the reason why we have so many people interested in the deal. I also make sure to talk about some small fees that are inherent in investing via Cereus Real Estate, but the returns that are projected are inclusive of those fees. And this is just a slide that kind of discusses the advantages of investing via Cereus Real Estate. Now, I want to point out that this deck is going to be available in the deal room. So it'll be available to you both in the recording as well as a downloadable deck in the deal room. So with that, I'm going to just say a few sentences about AJ. Then I'm going to allow him to kind of go into his story because I think it's so interesting. But just to say a few words, AJ Peak is a founder and CEO of Health Wealth Capital. Founded Peak Dental Services and grew it to an incredible, how many zeros, how many figures is that? 100 million of revenue annually, and has backgrounds at Merrill Lynch and McKinsey. And, let me stop it here and really just let you kind of talk to us in your own words, AJ. Let me go ahead and spotlight you, okay?
Well, thank you for everybody taking time to listen to me and Health Wealth Capital story. But let me first introduce myself, and it will see how it's connected to what we're doing now at Health Wealth Capital. I grew up in rural Minnesota in the middle of nowhere. Went to school on the East Coast, Carnegie Mellon, studied business. Uh, was very fortunate to start with McKinsey and Company in my early 20s. They sent me to business school, the Kellogg School of Management, and I continued to work at McKinsey and Company for the better part of my 20s until I was turning 30. I'm 48 now. And as I was turning 30, I thought I knew it all and had a burning desire to start a business. So I resigned in good terms, knowing McKinsey and Company would always take me back, our global firm, to start a business. And I had a few ideas. It just so happens my father, who lived with his family, but my mother and him lived in Colorado Springs at the time, and he had a small dental practice. He was a dentist and 60 years old at the time. This is 18 years ago. And he said, "Hey, the dental industry is consolidating. There's these group practice models that are really interesting." One thing led to another, and he was joking. I took him serious, put a business plan together, and started it from him as a test case with a little less than 1 million of revenues and 4 employees. Turns out to build a large dental group was materially harder than I thought. So turns out I didn't know it all, had a lot to learn, but despite myself, I grew that into quite a large business. We were about 50 million in revenues when I did a majority sale to private equity. My legacy investors at that time got a 5x return, some of them higher than that, and then continue to run that business and double it again. It's about just shy of $100 million in revenue on that front. And it was during that journey, so it's now about just shy of 700 employees, multi-state, that I was running dental offices, multi-specialty throughout the state. It's during that time when we'd be buying a dental office and occasionally the dentist owned the real estate and had a problem. They needed to sell the real estate for liquidity reasons and often to get off the loans. So 10 years ago, I sort of set up friends and family money to start to buy these dental buildings under a triple net lease arrangement 10 years ago. So I've been doing this now this fall, 10 years, owning dental buildings in particular and medical buildings on that front. Fast forward to, 2 years ago, had the impetus to do this in a more scalable way. I transitioned to becoming a board member on Peak Dental Services side and migrated to doing this in terms of a roll-up play in healthcare. There are market precedents that I'll talk about later, where just like the dental business I built, I got a very nice valuation for building a large business, far better valuation than if you were a solo practitioner trying to sell. The same premium exists in real estate in niches, and particularly in medical buildings, since that's very much the upside scenario I'll talk about in my returns. So when now our full-time basis at Health Wealth Capital, we have over 100 million of assets under management. We're buying a building across the country, one a week. We're in 30 states today, over 80 buildings presently that we control or under contract to close. But we're not just real estate folks. My entire team are former medical operators. So when we look at tenants, we've actually been in their shoes. And when somebody gives us a profit and loss statement, we actually lived it. And it gives us a kind of first rate look to get better leads or understand if this is a good credit risk for us to do when we're going to buy the building. Now, it's not just me. There's a larger team than this, but I also have a business partner, Justin. Just so happens he built a bigger business than me. It's now over 400 million in revenues in a dental business on the East Coast. Former investment banker who's a part of the team, Derek, on the capital raising front, deep in expertise in real estate with billions of assets under management, his former experience. A lot of analytical help from the Caston Group from Amman. He's stateside trained, small investment bank in India. It's in fine print, but important. If you go back just for a second, we've been working with the same legal firm for over 15 years. They have deep expertise in triple net leases and real estate, have a ton of expertise. Joe's the partner, but at any given week, we have about 5 attorneys working with us to close on the volume of closings we have. Weekly Accounting's a third-party firm. We do bank reconciliation on a weekly basis. Anybody that understands finance, even my former business, we couldn't do bank reconciliation that quick as we do with this one. And then our tax and accounting firm is a large regional firm used to real estate syndications, just being very accommodating to our shareholders. Again, I built now Health Wealth Capital has over 100 million of assets under management. It's my second $100 million company that I built. This one I've done even quicker. Uh, I personally have done over 120 commercial leases. I need to update the deck now. I think Justin's done like 300. So between the two of us, we're now about 400 commercial leases that we've personally done, negotiated, whether with a tenant or the buy side, raised over 100 million of capital through my various business ventures. Now, I love alternative investments and I invest in multifamily alternative investments. And it's something that many of us are very familiar with, buying apartment buildings through syndications like ours. It's very helpful because people understand that to compare and contrast to what this fund is, a medical triple net lease. If you're joining and you're new to real estate or you've been in real estate a long time, you probably have never even heard of triple net leases, or you've heard it and not sure what it means. So I'm going to unpack that here and compare and contrast to multifamily or apartments. And the first is competitive risk. I live in Colorado. I look out outside my window, and it's just a ton of population booming. And so you see apartment buildings going up left and right. And that, of course, can create some competitive pressure. In medical buildings, there's such a shortage of doctors, dentists, dermatologists, you name it, veterinarians, that oversupply is really restricted because there's not enough providers. So we're merely owning a building with a going entity already, but the competitive risk of moving around is pretty difficult, not to mention it's very sticky to move these things is quite costly. Operational risk, I'll talk more in a bit about triple net leases, but all of the maintenance costs, the taxes, insurance are pushed onto the tenant. In our case, they're medical tenants. Economic risk, uh, whether you own a pet, my dog ate a whole bag of Halloween candy, it's a true story, and $5,000 later, emergency bill, I paid it. And, regardless of the recession, but the downside, a lot of our buildings are operated by dentists or veterinarians. They're kind of semi-recession proof. If you have a toothache or you have a medical necessity, you're going to get taken care of. And that's consistently proven out in these industries. Tenant turnover, our leases are oftentimes anywhere from 10 to 15 years with commercial tenants. So we don't have that turnover risk. We're not buying vacant property, trying to hope and pray we can raise rents. We know that we have guaranteed kind of lease increases year over year. So we don't have the short-term leasing risk and rent delinquency, unlike multifamily where you're sort of FICO score based and, does this household have enough income and keep their job to pay rent? We actually are going off of medical tenants. We're doing full financial underwriting. My team, we've all run these and have underwritten like over $1 billion of healthcare operations. We do full internal kind of quality of earnings reviews of our tenants, just knowing they have strong, high margins, ability to pay rent a long time. When you put this all on one page and kind of compare and contrast, flipping forward, going to the next slide, this sort of side by side tenant type, we're only healthcare providers. Over 80% of the portfolio is dental, and that will continue to be the case. Veterinary and dermatology, urgent care, orthopedic surgery is the other sliver. Lease duration, compare and contrast, this is not a 1 to 2 year lease. These are 10 to 15-year leases. Tenant credit risk, very low, high margin businesses. Over 70% of our portfolio has corporate guarantees or backings. These corporate groups have over 50 million of revenues. Operating expenses, it's almost zero. The NNN stands for the triple net. It's net of insurance, taxes, maintenance, and repair costs. All of that is pushed onto the tenants in our relationships. Demand volatility, we're sort of an essential service, and I'll prove that out here on a future slide, just how resilient the dental industry is, and the veterinary and medical is very similar. That allows us to get very predictable returns. When we forecast cash distributions, I've been paying at the 8% cash distribution level for over going on 10 years and only suppressed it during 6 months during COVID, and then I made it up. So we know with high degree of certainty what our distributions are going to be. All of our tenants are current and have not had any vacancy.
And just to jump in here, if it's not clear so far, and I know you'll get into the details, Health Wealth Capital is not owning the actual practices themselves. They're owning the real estate of the medical office building and then leasing it to these very high quality tenants, which are essentially these medical practitioners, and their practices and businesses. So just wanted to make that clear and just interject, if you have questions, as you think of them, throw them into the Q&A. You should see that interface on your webinar screen, and we'll get to them in the latter part of the presentation, okay?
This is just MOB stands for medical office buildings. The occupancy, this is for the average, um, is over 93% and climbing. There's just a shortage of medical buildings on that piece. Ours are 100% vacancy, and when you go in a more under a microscope for dental and veterinarian, it's just incredibly shortage of supply. They're very sticky tenants, is why the majority of our portfolio is those two tenant types. You can page forward. So why triple net leases? One is predictable cash flow. We know within 90 days, usually far sooner of usually within 30 days of using your money, we're issuing distributions because we know with certainty what the free cash flow is. It will be close to 7% in the first year and will climb to 8% by year 3 to year 4. And we know that because of the guaranteed rate increases on our leases. There's annual 2 to 3% rent increases, which we pass on to our investors. Long-term leases, we're sort of going for 10 to 15-year leases. Occasionally, we'll go down to 5. Minimal operating risk. These are all triple net lease, meaning it's sort of maintenance, insurance, taxes are all pushed onto the tenant. And that also means I have a small team really that manages the sort of landlord responsibilities across 30 states. We used 30 different criteria when we're doing diligence on our properties. I'm just sharing a few that you might not have thought of, but we actually auto score 30 different criteria when we're evaluating a building. A couple things that you may not think of, we actually use Google reviews. Being operators of medical businesses for the last 18 years, shouldn't be surprising. High Google reviews, even though they can be semi-gamed, high Google reviews have a high correlation with strong financial performance. If you're a bad financial performing medical facility, it's very rare that you have strong Google reviews. So it should be intuitive, but we've empirically been able to prove that with the other businesses that we've built. A high rent paying capacity. Our upper limit is the rent needs to be at no more than 10% of the revenue. Oftentimes it's far less than 4 or 5. Long-term leases, we're going after favorable market conditions. We'll go into some smaller markets, but it must have, really trying to push for 50,000, a growing population within 10 miles or more. So that's still a fairly good sized place. A community that with that much population would have multiple dentists or veterinarians to support it. We're queuing off of an 8% cap rate. If you're familiar with real estate and how it's purchased, a higher number means it's at a discount and a lower number is a premium. Our weighted average in the portfolio is 8.2 cap rate that we buy. Now, dental is a deep experience in my team. It is one of the most forgiving, lucrative industries in healthcare. It is the largest healthcare vertical. It's bigger than oncology, dermatology. There is no healthcare vertical that's bigger in terms of commercial spend. So this is consumer spend in billions. And you can see in 2000, it was 107 billion. It's now nearly 190 billion. Only 2 years on the previous 24 did they contract. One was COVID, and the other one was related to COVID. So in 2020, contract should not be a surprise. Everybody had delayed treatment and did it in 2021. So 2021 is an artificial year where there was a sort of rebound. Had it been more smoothed out, you would have seen every year other than COVID it increase. It's just an incredibly favorable industry with strong economics. We're not running dental offices. All we care about is they continue to pay us rent. But in terms of the credit that we're in, it just means the downside protection you have as an investor is really strong. On the right-hand side, it's fine print, but we're just trying to share. We're buying these things often for an 8.3 cap rate. A very well marketed dental building today is selling at a 6.8 to a 7. It's still commercial real estate. It's always very opaque, and there's some people that know what they're doing and many that don't. If you know what you're doing, you actually today have a very good opportunity of selling for a 7 or a 6.8 cap rate. So there's a lot of implied upside even the day we buy these things at the deals that we're finding. If you push forward how we're doing this today, I'm closing on 6 buildings tomorrow, 4 next week. Our average is 1 a week. It's a little intense this week and next week. The way that we manage this is down to a science. We auto score, and our goal, and we've maintained this now for over a year and growing, we're bringing in 30 leads. So 30 different buildings from different sources a week. We then auto score them on 30 different dimensions, meaning we screen out automatically a bunch of them. Usually more than half get immediately, they're bad leads. We're not going to pursue them. We will then go deep into 6 to 8 modeling out, and we've been averaging now close to 5 after we model them out, 6 to 8 of them a week. We've consistently, for over a year, submitted 4 offers a week. The last 6 months has been closer to 5. Our win rate's about 15%. This is it. If you're a business person, it's a funnel. We manage this funnel religiously like engineers. We're always looking for more lead sources of good dental buildings or veterinary and medical buildings. But we've really honed this with the team to be able to consistently submit 5 offers a week. Once we get one accepted, so it's nearly one gets accepted a week, we'll then do deep financial underwriting of those tenants while we're putting together the purchase sales agreement. We typically then will close within 3 months of a signed letter of intent.
AJ, I just wanted to point out what you said earlier in that you're winning about 15% of the offers you make. So that means that 85% of the offers you make are actually going to other buyers who are paying more than you,
That's right.
right?
That's right.
For the viewers who kind of understand capitalization rate, that means that they're willing to pay a lower cap rate than AJ's team is willing to pay, and that's where a lot of the implied upside is coming from here.
You're not going to be able to read this. It's on, you click to the next page. This is just an inventory. You can look at this materials of all the properties that we have today. This is updated so often. It's now up to 80, and the net operating income is actually 10 million on this front. And it's not Dr. Shin's fault. A lot happens even in like 3 weeks. So this is that funnel. Every week we're getting more deals, and sometimes we'll get nice portfolios. In fact, the last couple of weeks we've had a few portfolios accept their letters of intent. We're in 30 states today. So in terms of geographical diversification, we're in every region: the South, Northeast, West, mountain regions, etc.
So the numbers are a little bit bigger in terms of net operative income now, and obviously the estimated valuation. Are the rest of the numbers still
Everything else
pretty
is
accurate?
same underwriting standards. Everything else is the same. Now there's 3 sort of ways for an exit, and I'm going to start with the base case, which we estimate sort of 16 to 20% targeted returns, and that's net of any of the fees in the promote. Just like Dr. Shin mentioned, 85% of the deals we lose. In the overwhelming majority of those lost deals, we're losing out to what's called 1031 buyers. Perhaps you have a friend, maybe you've done this to yourself before. There's a 1031 tax exchange is you can on a tax deferred basis sell a piece of real estate and buy something else. Well, what you find in medical triple net leases, a lot of people, families in particular, that have owned a duplex or an apartment building with like 4 units for many years and they've done all the property management, they're so tired of self-managing these buildings that they want a 1031 into a triple net lease building. Well, then if you're thinking of the universe of triple net lease buildings, it could be a fast food restaurant. And I don't know about you, but they typically have the shelf life of a fruit fly. Restaurants don't make it very long. And so people know medical has a stronger survival rate. They're going to do much better. And so you see a lot of 1031. They're under a time pressure. They don't really understand things as well. So they tend to be the ones that buy many of these buildings. And if you know what you're doing, if you work with the right real estate brokers, there's a strong conviction that even today we could sell the portfolio for close to a 6.8 cap rate, which is exactly tied to that 16 to 20% base case. Meaning the base case is we'll sell at a 6.8 to 7. There's a strong belief we could do that today. We're not selling today. But that is where the base case comes from. And we would sell these off in years 4 and 5 in a base case scenario, really targeting those 1031 buyers, like I just explained. Now, the premium case and what my team is after, what I get excited about, I have over 7 figures of my own capital in this business and fund. And why, I'm highly motivated as we do this. We are a roll-up strategy. Bigger is better. Just like the dental business I built, I'm getting valued measurably higher than an individual dentist. In real estate, institutional capital, REITs, real estate investment trusts, as well as other institutional funds will pay a premium for aggregating niche real estate asset classes. And I'll share some more proof behind that here in future slides. There's strong indications that we could sell for as low as a 5.5 cap rate, pooling these assets together. Typically, a minimum threshold is having 10 million of net operating income, which we just recently achieved. But something closer to 20 or 30 million gives even a higher probability of an institutional sale. So that's the upside. There's another scenario which we'd actually convert to a REIT and go public. Now, there's several medical REITs that have gone public with less than 15 million of net operating income. That is sort of a possibility, but the best case, we would sell all of the portfolio to an institutional buyer for the premium exit. That would pencil in close to the 25 to 35% internal rate of return. And we'd be targeting that more like in 36 months. You can look at this when you download the slides. On the y-axis is cap rate. So on the high end, 8%, which is where we're buying buildings. On the low end, you'll see this green squiggly line, and that is the implied cap rate of medical REITs. This is publicly available data. And a lower number, if you're new to real estate, or have to remember, a lower number means a premium valuation. In all high interest rates environments, notice how medical REITs are trading almost like a treasury bond, meaning it's a premium asset. Investors are willing to accept a lower returns because it's a safe haven asset. At that 4.58 was what at the end of 2025 medical REITs were trading at. Our base case is to sell in that gray area between 6.5 and 7.5, and that's the base case returns. But there's a huge spread there to 4.58 if we were to get a premium. We're not saying we'll get a 4.58. We're actually saying we'll give some of that spread to the institutional buyer and somewhat to be to us. And so, the upside being closer to a 5.5 is what we're anticipating and going after for the upside return. If I had to put on one page what makes us different, if you missed my story in the beginning, myself and Justin and others on my team, we've run $100 million dental businesses and medical businesses. When we analyze the financials of our tenants, we've lived it. and we know this space incredibly well. There's 100 private equity backed groups in dental, about 50 in veterinarian. I speak at the industry's largest conferences every year. In fact, next year, hosting a 4 hour panel in the space. We generally know the insiders in terms of how to really understand the financial strength of our tenants because we're the only owning the real estate. We just want them to pay rent for a long time. But that gives us unique ability. One is to understand the risk, who's doing well, and two, it gives us great opportunities for leads. And third, we know the CEOs of the groups of these that have the leases. And sometimes the lease isn't what we want it to be. We can call up, negotiate with the CEO because we have access and end up coming away with an amended lease that brings it up to our standards, a much better investment friendly real estate asset. That touches on the second part, our strategic industry connections illustration of why that gives us better leads, or we can construct better deals. And how we construct a better deal is actually improving the current lease when the building's being sold. Market-driven property selection, we're using 30 different criteria, and we're going, very deep on the financial analysis. Proven triple net leases. I personally done 120. Justin, who's joined, has done over 300. Robust downside risk management. 60% of our tenants have corporate backings of over 50 million in revenues. If one location is going to go bad, they have the wherewithal to continue to pay us rent. That being said, I've got three executives on my team. All of us know exactly what to do if one of these tenants defaulted. We would actually get a provider in that business the following week, hiring a per diem, and we would run the business to keep the lights on, collecting revenues, keeping the business moving, and ability to pay rent. We would work with a medical practice broker to get it sold to a new buyer. They just step into that lease. I hope that never happens. I don't think it ever will, but I think we're the only real estate provider that has that expertise on our team. Scalable growth exit, just, we're really pushing to get closer to that 15, what's more likely going to be 20 million in net operating income and going for that sort of premium exit, very much like the other business that I created. If I just had to recap, base case, this is net of all the fees, is which you would receive all in 16 to 20% internal rate of return. If you're not remembering what an IRR is, it's a compounding annual growth rate that your returns would grow on a compounding annual growth rate of 16 to 20%. The upside, this is us getting a premium exit, that we are very much a roll-up asset aggregator and a niche medical assets is 25 to 35%. What that equates to is a multiple of your money is 2 to 3 times your money based upon those estimates. Cash on cash returns, it's going to come in at 7%. It'll rise to 8. High level predictability for us because of these are triple net leases. We start within 30 days of deploying your capital. That typically means within 90 days of your invested capital, you'll start receiving distributions, sometimes a little sooner. Total aggregated purchase price, you'll be investing in Series 3. Series 3 is targeted to buy 75 million of real estate. That's about 6 million in net operating income. That gives you diversification over 50 medical buildings, meaning you'll own a fraction of 50 medical buildings, just giving a ton of downside protection. Here's just pictures of a variety of the buildings we have in our portfolio, as well as the ones you can page forward kind of quickly, the ones under contract to close here in the future.
Okay. So let me just kind of wrap up here and then we'll get into some great Q&A. So as I go over logistics here, take advantage of this opportunity to put your questions into the Q&A and we'll go through them one by one. And I've got some additional ones on top of that. So, you know, if you look at our timeline here, the specific dates are in the emails I've been sending out, but essentially this deal offering will encompass the month of July. So we're about a week into it now. Take the next, if you're interested in the deal, make sure to put in a soft commit. There's ample links and ample emails that you've been flooded with in your inboxes. Sorry about that. But utilize those links to place your soft commit as well as start your investor accounts. And there's a series of paperwork steps to go through there. It's very self-explanatory. Feel free to reach out to my team with any problems from that. But ideally, all of the paperwork, accreditation, and all of that will be done uh, by 3 weeks into July. And then you'll take that last week to transfer capital to our funding deadline, which is essentially the last week. All right. Feel free to reach out personally to me if you need to chat about this deal. There isn't much, admittedly, there's not a ton of availability on the calendar right now. If you can't find a spot and you need to chat, we'll make it work. So just reach out. Okay. So let me go ahead and stop sharing my screen and then we'll get into some Q&A. Okay. Joshua's put a couple of questions in here. AJ. So the first one is, I'm gonna preface this question by maybe asking a more general question first. Who are the general groups that are selling their medical office buildings, and why do they choose to sell their buildings to you?
So the overwhelming are providers who oftentimes have owned the practice and they've owned the building, and they've just recently typically partnered with a medical service organization, a bigger corporate buying group. It could be dental. In dental, they're called DSOs, and medical MSOs, just larger groups. In overwhelming times, they remain an equity owner. So they will often sell their practice and they will retain 30% ownership either in the bigger mothership or in their local practice. There's all kinds of different structures. And they then are looking for liquidity. They don't want to be the owner of the real estate anymore. They're just looking to put their wealth somewhere else. So that usually is an inflection point, and we're buying through them. And that gives us a unique ability because we know the players in the space, certainly the geographic places, and we understand the financials. We're not taking an individual risk. We're then understanding the bigger corporate guarantees behind these leases. So the overwhelming buyer is often provide or seller is providers, solo providers who have now partnered with a larger group.
So, to sort of think about it from the perspective of the medical practitioner, they may have a lot of their liquidity and net worth tied up in the actual physical building in which their medical office resides, right? And their medical practice resides, that is. So, selling, the medical real estate can really decrease uh, their sort of concentration of wealth that is connected to that building. So then they can deploy it somewhere else. So that's what I picture is happening here. So to get at Joshua's question, though, his question is this: there has been a trend of DSO consolidation in this space. Do you have a concern that some of these properties are prone to some sort of consolidation and closing, of these locations, which could jeopardize the returns and cause vacancy?
Uh, the short answer is um, we generally know there's tall tale signs of locations that are susceptible to being closed or consolidated in metropolitan areas. And otherwise, having owned, like I've been on the other side, running dental offices, you don't want to move. It's a pain, and you don't want to consolidate. If you have a high performing location, you've put over 750,000 to 1 million in assets in the building. You don't want to move if you don't have to. And revenues tend to be the tall tale sign on that front. So we're cherry picking. We're looking for the best kind of providers with strong margins, strong groups that are just not susceptible to this. And the dental industry has not had mass consolidation or vacancy. There's been a few prunings here and there, and on that front. And normally, it was pretty obvious where the facilities was making sub, $1 million in revenues, and those are just not the kind of assets we go after on that front. The other way to look at it is we do so much analysis on these deals that Justin and we have bought hundreds, not 10, not five, hundreds on a combined basis of dental offices. We don't want to own the real estate if we wouldn't buy the dental office in our previous life. I mean, we're going after sort of really stronger areas on that front. The I don't know if you want to characterize the other question, Dr. Shin.
Yeah, this question I think is a really great question. Thank you, Joshua. But basically, it's getting at the. I think it's touching on a couple of things here. It's touching on the strategy with which you are selecting your deals and you're making your offers, but also just a basic question of, why would they sell? These are high quality practices, obviously, because you're selecting for that. But why would they sell at a cap rate of 8.3 or 8, which is generally your average, where maybe they can hold out and get someone who is going to be doing a 1031 exchange and they're willing to sell at a lower cap rate or higher valuation?
Uh, 85% of the time, they do hold out and they do get high valuation. 15% of the time, they're not educated, they're not working with a good commercial broker, or we're finding the lead direct. So, I mean, we're doing a direct negotiation with the seller and we're telling them, here's what we're willing to do and here's what we're doing. And they trust us and they move forward. There's a third scenario. Oftentimes, the deals being advertised might be an 8 cap rate because there is additional risk because the lease is not a good lease. So there's different types of leases. There's what's called a single net, double net, and triple net. And oftentimes, these deals will be advertised, let's say, as a double net lease, which we don't want. Well, we'll put an offer on it because we know the corporate team of the behind that tenant. True story, we bought a building in Oklahoma. We got it under contract for I think like an 8.5 cap rate, and the lease was not good. But I knew the CEO, we knew the CEO of that team. And first of all, we were able to find out the financials. The tenant didn't have the financials. We were able to get the financials on that location and negotiate with that CEO to extend the lease and convert it into a triple net lease. So our value add, if you were to think of multifamily, their value add is after the buy, they're renovating, they're trying to raise rents. Our value add is actually constructing these buy side opportunities on the front end. It's a lot of work. They're not laying around on trees, and we're quite ingenuitive in terms of creating these eight cap rate buy side opportunities, but it's not easy. They're not laying around.
Okay, perfect. So, I think you may have touched on this, but so you all are north of 80 assets right now in the portfolio. Um, what has been your experience with default rates? And have any tenants defaulted on lease payments so far?
Uh, Zero default in 10 years. And maybe even better state. I live in the state of Colorado, or the other business I built, I think was the third largest in the state. Uh, it's very rare in the entire state for there to be one bankruptcy in dental. You have to sort of let that sit in. Like it's just it's one of the lowest bankruptcy SIC code. Doesn't mean that everybody's perfect or the hard management business is, but this is a very favorable industry on that end. But we have not had any defaults, and the in 10 years, but we're also trying to stack. The average is really good in our industry. We're trying to stack it in our favor by really going after more higher performing through financials, et cetera. So we don't have to worry about that.
Perfect. Okay. So, two kind of related questions. So, um, inherent in any real estate deal is usually debt, right? So loans that are allowing you to purchase these deals. So could you characterize what percentage of the purchase of your average medical office building is equity with investor capital, and what is debt, and what is the typical kind of terms of the debt that you're securing for these purchases?
So we'll do what's called loan to value, 65%. So it's 35 equity, 65 on the debt side. They would lend us more. I've chosen to be a little more conservative. I used to borrow up to 80. I don't do that. We borrow at 65%. If you understand debt service coverage ratio, that's how much free cash flow you have to cover your debt. We're 1.9. Um, Banks would lend to us at 1.2, meaning we have a ton of free cash flow and we underwrite to that. We're doing fixed rate debt right around 6.5%. I'm getting term sheets some days at 6.2 and up to 6.5. 25-year amortization and a 5-year term is the typical debt that we have. Um, I saw that another question was, are these triple net leases? And the person asking the question is an astute real estate person, or are they absolute triple net leases? The distinction for people that don't know, under a traditional triple net lease, the landlord is responsible to replace the roof, the walls, and the plumbing, as an illustration. All the fixed infrastructure you're responsible for, and the tenant's responsible for all the other maintenance, taxes, insurance. And then an absolute triple net lease is the tenant's responsible for all walls, everything, plumbing, you name it. And uh, the answer is we do both. In Series 3, we actually have over half our absolute triple net lease and half our triple net. We do a third-party inspection of every building, and if we don't believe that the roof will make it during our hold period, we actually negotiate and win 85% of the time a holdback to repair or replace the roof. If they don't, we adjust our model and we will fund enough money to replace that roof. As an illustration, I think last year we did 10 roofs. Like, we're pretty aggressive. We don't want to deal with a surprise during a hold period, so we take care of that right away in the front end.
Perfect. This is another good question. Who owns the dental equipment attached to the office? When this equipment becomes obsolete, who pays for the replacement? And then is there any, let's deal with that part of the question first.
Tenant owns the equipment unless the default, and it's ours, but it's very rare. I don't, um, not a privy to that happening, but I'd happily take it and probably make more money on it. So the tenant owns the equipment. Um, I think the second part of that question was the tax benefit to the limited partners. We do cost segregation studies on every business, every building that we buy. And if you're not familiar with cost segregation studies, the IRS has very favorable rulings. Whether or not you like our current president, they did pass a pretty favorable real estate ruling last year. And you're able to, the land, you can't depreciate the land, but everything above that, you can sort of do this complicated cost segregation study. It's a third party that does it. They're like 60 pages long. And then there's these very favorable acceleration clauses that we take advantage of. You don't have to understand any of that. We do all that work. What it ultimately means to you as an investor is somewhere between 55 and 65% K1 losses in your first year. It's just on paper. So just walk through a simple example. If you invest 100,000, you're going to get roughly 7,000 in cash distributions the first year. Your first year 1K1 is going to have somewhere between a loss of 55 to 65,000 in year one. Now, these are passive losses. Work with your own accountant what that means for you, but it's a very favorable tax benefit in the first year.
And to be clear, that does pass through to you as an individual investor. It just goes straight to you. You're like a shareholder. So you get a distribution of the depreciation as well as the cash flow as an investor in this deal. And I did want to point out how struck I was at the debt service coverage ratio that you mentioned. So, typical multifamily deal, we're all very comfortable at a debt service coverage ratio of 1.25. That is where a lot of these value add deals live, and that is industry standard for a lot of these things, because the cash flow can be a little bit scarce in the beginning of a value add deal. But the debt service coverage ratio 1.9 means that in any given month, j- just in terms of cash coming in the accounts, it's significantly more than they need to make the debt payments. I thought that was a really interesting point that you made, and it kind of shows some of the advantages of this type of investment versus traditional multifamily. I think there are pluses and minuses to both, obviously, but just wanted to point that out. Um, so, next question from Joshua here. Do you get concerned about fast-growing DSOs that are quickly adding dental practices with aggressive growth strategies? Yeah, that's a good question. So it's kind of like a supply and demand question, right? So just like multifamily can become unbalanced due to overbuilding of apartment complexes, can the supply and demand be unbalanced due to increased building medical office buildings and practices opening up?
The last 3 years have not been kind to medical roll-up strategies. High interest rates and high inflation has really dropped anchor on some of these fast-growing strategies. So the number of groups that are growing, they're no longer growing fast, what I would consider to be fast. It's really the strongest will survive, and everybody else is sort of healing from maybe too fast of growth, and they're just worrying for what's called organic growth, it's improving their margins. And so I'd say that wave of a frenzy that kind of led up to during COVID, maybe for the first year, 2021, has really halted. There isn't anybody rapidly growing. There's people growing at a slower pace now in the space. There's far more DSOs that got put on pause. They stopped growing and they're just working about organic growth, and they're paying, off their margins because of there's some inflation pressures on that front. And so I don't. There's not an oversupply of dentists, which is the great fundamental for that. And the CapEx, the capital expenditures to build these dental offices is quite strong on that end. What's unique to my team is it's a very friendly industry. I can't say that you can figure this out in a day, but we generally know the groups that are doing quite well and have strong corporate. By the way, we get their financials. Plus, we talk to them in the hallways. So there are, I would say, 4 or 5 in the industry that we avoid. And we know that, when we find out they're the corporate backers for a couple different reasons, even if we think the deal is a great deal, we pass. But generally speaking, the dental industry is quite strong. That the overgrowth is pretty limited throughout on that front, and you still see individual dentists doing quite well throughout the country.
Maybe I'll take this next one, AJ. So someone is asking for a little clarification on the depreciation. So this is a passive deal. Uh, as an individual investor, your capital is being pooled alongside every other investor, and Cereus Real Estate, as a fund, is investing into health wealth capital. So uh, we are passive investors, and therefore the depreciation associated with this is lumped by the IRS and kind of sequestered on the passive side. And we're all medical here, and a lot of people like to think of this as a blood-brain barrier between passive and active income. So active income is like the W-2 income you make as a salaried employee. Most doctors and a lot of healthcare professionals now are salaried. So depreciation from a passive deal cannot generally cross over that barrier except for a few scenarios. So just like medications can pass over that barrier if you have a fever or there's inflammation, the equivalent cases are if you're a real estate professional or if you have an active business like a short-term rental. That's kind of a loophole there. But aside from those two scenarios, it's generally sequestered on the passive side. Now, that doesn't mean that it's not useful. It is very useful in that when you have other passive deals exiting and you have a gain, the passive losses from this deal can shelter those gains completely. So as you invest into more passive deals, and it's almost like dollar cost averaging into different deals. You're diversifying, you're investing over time. You can be very strategic about covering gains with losses to make this type of investment incredibly tax efficient, which is why I really love it. So, hope that answered the question.
And to even put personal example on that, I still have wealth in stocks and bonds, and my financial advisor loves that I have this alternative investor because it offsets the gains that they might have in the stock markets, etc. So if anybody does have, a diversified portfolio with stocks and bonds in a non-retirement account, that's all in the passive bucket, and this can be quite advantageous to that.
I might push back because I think there is a little limitation on using real estate passive losses against equity losses. But obviously, this is very technical, so it's a great question to bring up with your own CPA who knows your tax situation. Speaking from the investor standpoint. Um, but I think that's pretty much bringing us to the end of the hour here. AJ, was there any kind of conclusion that you would like to leave our investors with?
Anybody has any questions, certainly Dr. Shin can reach out anytime. Just appreciate your time on that front. Just a ton of conviction. Like I said, I have a lot of my own wealth in here. I'm the sole guarantor on all of the debt, as any indication of my commitment and skin of the game. I think a lot about wealth preservation, and um, you know, take this quite seriously, not just to grow my own wealth, but on behalf of my investors. So thank you.
Perfect. Well, thank you so much for your time today, AJ. Really excited about this deal. Thank you for spending the hour with Cereus Real Estate, and we'll talk soon.